One of the most crucial elements of successful trading is setting realistic and achievable goals while managing expectations. When traders set unrealistic goals, they often fall into emotional decision-making, take unnecessary risks, and ultimately face significant losses. By understanding the realities of the market and defining clear, practical objectives, traders can improve their performance and sustain long-term success. The key is to remain disciplined, adapt to market conditions, and focus on consistent growth rather than quick wins. Setting realistic expectations in trading is essential for long-term success. It helps prevent overtrading and impulsive decisions that can lead to unnecessary losses. By managing expectations, traders can reduce psychological stress and avoid burnout, allowing them to stay focused and disciplined. A structured framework for measuring progress ensures steady improvement, while avoiding the temptation of chasing high returns minimizes financial risks. Ultimately, a balanced approach leads to sustainable growth and better decision-making in the market. Many traders enter the market with unrealistic expectations, which can lead to frustration and poor decision-making. Expecting to double or triple capital quickly, believing every trade will be a win, or assuming market movements can be predicted with certainty are all common misconceptions. Even top traders lose 30 to 40% of the time, highlighting the importance of risk management and realistic goal setting. Trading is not a guaranteed daily income source, but rather a long-term strategy focused on steady gains while minimizing losses. The key to success is patience, discipline, and understanding that sustainable profits come over time. Setting realistic trading goals begins with understanding your financial situation, available capital, and time horizon. Common objectives include capital preservation, where the focus is on minimizing losses while growing investments conservatively, or income generation through dividend stocks or short-term trading. For those aiming for long-term wealth accumulation, compounding gains over time is key, while speculative gains require strong risk management due to higher volatility. A well-defined goal, such as growing a portfolio by 8% annually while keeping drawdowns under 10%, helps traders stay disciplined and focused on sustainable success. Setting smart goals in trading helps create a clear and structured approach to achieving success. Your goals should be specific, defining exactly what you want to achieve, and measurable, allowing you to track progress with clear metrics like ROI. They must also be achievable, considering your capital and market conditions, and relevant, aligning with your long-term financial objectives. Finally, they should be time-bound, giving you a set time frame to evaluate your performance. For example, a realistic goal might be aiming for a 2% monthly return using swing trading strategies while managing risk effectively. The market is inherently uncertain, and even the best traders experience losses from time to time. Understanding different trading styles is key. Day traders aim for small but consistent gains, swing traders manage fluctuations over the medium term, and long-term investors focus on growth despite market corrections. Setting realistic expectations is crucial, as historical benchmarks show that the S&P 500 averages 8 to 10% annually, while hedge funds aim for 10 to 15%. For day traders, a solid return is around 1 to 3% per month. By acknowledging market realities, traders can develop a strategy that aligns with their goals and risk tolerance. Risk management is crucial for maintaining long-term success in trading. One of the key risks traders face is drawdown, which is the decline in a portfolio from its peak before recovery. For example, a 10% drawdown requires an 11% gain to recover, while a 50% drawdown demands a 100% gain, making recovery increasingly difficult. To protect your capital, it's essential to set a maximum drawdown limit, typically around 10 to 15%, and enforce it through stop losses and proper position sizing. By managing risk effectively, traders can preserve their capital and stay in the game for the long haul. Setting a long-term trading goal is essential but breaking it down into smaller, manageable milestones makes it more achievable and keeps you motivated. A structured approach could involve aiming for a 2% monthly gain, achieving a 6% cumulative return each quarter, and ultimately reaching an annual growth target of 8 to 12%. Regularly reviewing progress allows traders to stay on track and make necessary adjustments based on market conditions. By setting clear milestones and evaluating performance consistently, traders can build discipline and improve their chances of long-term success. Balancing risk and reward is a fundamental principle for long-term success in trading. A key rule is to maintain a risk-reward ratio of at least 1.2, meaning for every dollar you risk, you should aim to make at least 2. Proper position sizing is equally important, with a common guideline being to risk no more than 1 to 2% of your capital per trade. For instance, if your portfolio is $10,000, a 1% risk per trade means a maximum loss of $100. By following these principles, traders can manage losses effectively while maximizing profitable opportunities. Effective risk management is crucial for long-term trading success. One key element is setting a maximum drawdown limit, which defines how much of your portfolio you're willing to lose before reassessing your strategy, typically 10 to 15% for beginners. Another critical aspect is understanding your win rate, or the percentage of profitable trades, and maintaining a strong risk-reward ratio, ensuring that your winning trades outweigh your losses. By combining these factors, traders can protect their capital, manage losses, and improve their overall profitability. A disciplined approach to risk management helps sustain success in volatile markets. Maintaining a balanced win ratio with a strong risk-reward strategy is key to profitable trading. This example shows how a 50% win rate with a 1-2 risk-reward ratio can still lead to solid gains. For every 10 trades, winning 5 trades at $200 each results in $1,000, while losing 5 trades at $100 each results in a $500 loss, leaving a net profit of $500. This approach highlights why having a structured risk-reward strategy is more important than winning every trade. By focusing on proper risk management, traders can remain consistently profitable even with a moderate win rate. Trading can be emotionally challenging due to market uncertainty, losses, and volatility. Without proper emotional control, traders may fall into overtrading, revenge trading, or panic selling, which can lead to further losses. To maintain emotional discipline, it's important to accept losses as part of the game, stick to a well-defined trading plan, and take breaks when stress levels are high. Using a trading journal to review past trades and learn from mistakes can also help build confidence and improve decision-making. By managing emotions effectively, traders can stay focused and make rational, strategic choices. Many traders fall into common pitfalls that can harm their long-term success. Chasing high returns often leads to over-leveraging or risky trades, which can quickly wipe out capital. So it's crucial to focus on consistent growth instead of short-term gains. Ignoring risk management by trading without stop losses can result in significant losses during market downturns, making it essential to set predefined stop losses and position size limits. Another major mistake is overtrading, which increases costs and risk exposure due to impatience or greed. The best way to avoid these pitfalls is to stick to a disciplined trading plan and only take trades that meet your predefined criteria. Markets are constantly evolving, and as traders, we must adapt by reviewing and adjusting our goals periodically. Conducting monthly or quarterly reviews helps assess performance, refine position sizes, and analyze winning and losing trades to improve future decisions. Additionally, long-term adjustments are necessary when market conditions shift, such as during economic downturns, requiring us to reassess risk tolerance and return expectations. By staying flexible and proactive, traders can align their strategies with changing market dynamics and sustain long-term success. Regular evaluations ensure continuous growth and adaptation in an unpredictable market. Setting realistic trading goals helps traders stay focused and disciplined while managing risk effectively. For portfolio growth, a 10% annual return on a $10,000 portfolio is a reasonable long-term objective. Monthly returns of 1–2% through swing trading provide a structured approach to consistent gains. Risk management is key, with a maximum drawdown limit of 10% to protect capital. Finally, maintaining a 50% win rate with a 1–2 risk-reward ratio ensures profitability over time. By setting clear, measurable goals, traders can track progress and adapt their strategies for long-term success. In conclusion, setting realistic trading expectations and goals is the foundation of long-term success in the market. By focusing on achievable targets, effective risk management, and emotional discipline, traders can navigate challenges and steadily grow their portfolios. It's important to remember that trading is a marathon, not a sprint. Consistency and patience will always outperform chasing big, risky wins. Small, sustainable gains over time lead to greater financial stability and success. Stay disciplined, stick to your strategy, and let steady progress be your key to long-term profitability.